Okay, good afternoon. Let us resume the conference. So this morning we had a series of very interesting papers. We've just had a very stimulating policy discussion, and it's a very nice way to wrap up the first day is to have the keynote. And so I'm very happy to be able to introduce Marios Angeletos. And Marios, I think, is a very good fit for this conference. But actually, that's a sentence I could say for any conference held by the ECB, because Marios has worked on many topics related to central banking. So sometimes these types of introductions are by, it's a list of affiliations. This person worked here, worked there, was educated here, was educated there. But actually, after a long time at MIT, now at Northwestern, let me more focus maybe on just reminding you on some of the topics that he has covered in his career. And again, when I looked at his list of research, I did it with a perspective from a central bank. And let me say, and also, not just from a monetary theory point of view, but also from a macroeconomic point of view. Because here at the ECB, we tend to have a granular to macro way to think about the economy, and also top-down as well. So, and then of course we have to think about monetary policy. So some of his work has been directly on monetary policy, the Taylor principle, forward guidance, optimal monetary policy with information frictions. So all of these are very straight to the point. But even before that, before we get to monetary policy, we try and understand what is driving fluctuations in the economy. So whether, and of course, a lot of what his work has done is integrate behavioral perspectives into how both households and firms make decisions. And this, of course, leads to a lot of interest in some of the big issues we face. For example, what exactly determines consumer confidence? What determines investor confidence? What determines how people form beliefs, especially when, of course, in the classic Keynesian beauty contest sense, everyone's is not just working out their own views, but what do I think about what other people think? And that kind of coordination issue, that learning issue, is so important in how we think about the economy. Super interesting in recent times has also been, of course, now we had this episode of high inflation, topics that he had been working on before then, about how to think about nominal rigidities, real rigidities, how a lot of these are indeed rooted in information frictions is super important. One big thing we also think about at a central bank is what is money? So on top of setting the interest rate, we have to think, okay, what exactly is money in all its forms? What determines liquidity? And one of the topics he's worked on recently is essentially the trade-offs in determining the interplay between the volume of public debt and its role in private liquidity. And again, that's really so important for us. Many topics which are very relevant for the ECB. But I think in today's keynote, he's going to revisit some of the topics that we heard about this morning, about monetary-fiscal interactions. So I'm going to hand over to Marios, and then at the end, there should be some time for Q&A. But over to you.
Thanks a lot for the introduction. I can only mess it up after that, so maybe I should step down. I will disappoint you. So we had a very interesting panel that was also a bit depressing about reality. So I will bring you back to the comfort zone of theoretical models, where things can be a little bit more, less gloomy. Okay. So what I'm going to be talking is about fiscal monetary interaction, which was the topic of many of the papers we saw today. I will be based in this on joint work with Chen Liang from Berkeley and Christian Wolf from MIT. And sort of two disclaimers before I jump into it. One is I'll try to give you both a bit of a methodological message and an applied message. And maybe it's bad to try to do two messages, but I will ask you to do that, so I'll try to deliver. The methodological method is going to be to clarify what we mean by fiscal dominance in models. And maybe that helps us understand reality. Okay? And fiscal dominance can be very different in a Sargent-Wallace model with flexi prices, can mean something very different than the New Keynesian model, and I want to clarify a bit that. The applied message will be about, if you want, a form of fiscal irresponsibility or fiscal inaction, slow adjustment in fiscal policy over the business cycle, why it could be good. So that may be an anticlimactic topic message to try to convey when we're thinking about what's going on in reality, but I want to separate. I'm going to be talking about the business cycle, not about trends and steady state. My focus is on the business cycle. Okay, so, I'm not sure. I seem to be, here it goes. Okay, I want you to focus on the following two questions now to start becoming more concrete. They're very related, somewhat different. The first question is, how much deficits contribute to inflation and through which mechanism? The second is, what kind of fiscal framework the central bank should prefer, according to the model? What kind of fiscal policy aids or interferes with the central bank's dual mandate to stabilize output and inflation? Should the central bank prefer something like an active fiscal policy or a fiscal policy that adjusts taxes and government spending fast enough, or a fiscal policy that fails to do that? Okay. These are the two questions that I want to address. And we can address these questions in different kinds of models. We can address them in flexi-price models where real economic activity is independent of monetary policy, such as Sargent-Wallace, or we can address them within the New Keynesian framework. So I'm going to commit on the New Keynesian framework, which means I'm committing about short-run dynamics. We're not talking about the long run here. But within the New Keynesian framework, there are still, I don't know why I'm also facing trouble with this. Okay, there are still two approaches within the New Keynesian framework to address these questions. One is to study fiscal monetary interactions within the representative agent New Keynesian model. And to argue that within that model, there is a regime of fiscal dominance, and in that regime of fiscal dominance, that's how fiscal policy matters. So what I'm going to argue is that in this, and that way of thinking about fiscal monetary interactions is delicate, fragile, and in a way that I will make clear, nonsensible. So I will try to move you away from this traditional approach of thinking about fiscal monetary interactions. And I will try to push you, still within the New Keynesian framework, but in the direction of heterogeneous changes in New Keynesian models. And by heterogeneous changes in New Keynesian models, my emphasis is going to be not so much on the heterogeneity, which is important, but primarily on the fact that because of incomplete markets, liquidity constraints, and other frictions, households are non-recurrent. We're going to have non-recurrent effects on consumption behavior. That's a mechanism, non-recurrent effects on consumption behavior, evidence on stimulus checks, and so on. We have ample empirical evidence on non-recurrent effects on consumption behavior. So I want to understand how fiscal policy affects aggregate demand, output, and inflation through that mechanism, and how that gives you a different way to think about fiscal and monetary interactions, and how it gives you different answers to those two questions. So first, I think the technology is not helping me. First, as I said, I'm going to revisit rank with fiscal dominance. And I want to remind you a little bit, the focus on the question, what kind of fiscal framework aids the central bank? The textbook answer you'll find in Woodford and Galli and others is the following, that the central bank prefers a fiscal policy that adjusts taxes fast enough, so that fiscal policy can make sure of debt sustainability, and then the monetary authority is free to regulate output and inflation. Conversely, slow fiscal adjustment is bad. Why? Because it opens the door to fiscal dominance, in which case the monetary authority loses control of output and inflation. The latter are instead driven by fiscal deficits. So that's the conventional way to think about fiscal monetary interaction. Slow fiscal adjustment is bad. The central bank loses control of output and inflation. I will argue that this way of thinking about the problem is subject to an obvious and discomforting paradox. What is the paradox? Within the new Keynesian model, inflation is pinned down by real output and real spending. So for fiscal deficits to drive inflation, it has to be that fiscal deficits drive real spending, which means Ricardian equivalence has to fail. But you are starting in a model where households are Ricardian, and you are requiring Ricardian equivalence to fail. There's something paradoxical about it. And I will explain that paradox by saying that within that conventional approach, fiscal dominance amounts to a purely self-fulfilling belief, a self-fulfilling prophecy that's exceedingly fragile in a way that I will explain. And once you refine away this pathology, the following is true within the standard new Keynesian model. Fiscal policy is relevant, period. Monetary policy is dominant, even if the Taylor principle fails. And finally, the traditional approach to fiscal monetary interactions is out. Now, if you don't like those conclusions, you need to move away from this model. How we're going to move away from this model? There are many ways to move away. I will move in a specific way, as I said. The way I will try to move I don't know if I'm doing something wrong. The lower part. No, that's okay. I'll keep giving it a try, but it's this, right?
This left and right, yes.
Okay, it's not just me.
No, it's not you.
Okay.
It's not working. So say next slide, my colleague will bring.
Okay, okay. So.
I checked the battery.
Okay, perfect, thank you. Okay. So I will move away from the standard representative agent new Keynesian model in the direction of dropping the assumption of a representative agent and allowing households to be non-Ricardian. So the mechanism is going to be different. Households are non-Ricardian, and that naturally allows deficits to stimulate aggregate demand and thereby output inflation. Basic intuition, old-fashioned logic, if you push the tax burden to future generations, or if you relax borrowing constraints for households, that will stimulate spending, output, and the like, okay? That's a mechanism that, as I will explain, is theoretically more robust, and it's also, as we discussed, supported by empirical macro evidence. And then what are the lessons that come out from this approach? That relates to two papers I've written with my co-authors. The first lesson is that through these different mechanisms, fiscal deficits can be quite inflationary, and in a sense that we make precise in our first paper, is that despite the mechanism being very different than in the fiscal theory of price level or than in fiscal dividends, you may end up getting predictions that remind you of fiscal dominance, that reminds you of the fiscal theory of price level, so highly inflationary deficits, even in situations that monetary policy is dominant. So it's no more about which authority is dominant. Maybe we should abandon that language. It's more about both policies naturally drive demand. And then it's a question of how much accommodative monetary policy is to fiscal policy or not. But it's not about equilibrium selection. Okay? And that mechanism is going to be disciplined by empirical evidence. The second lesson that I will try to focus in today's talk is going to go to the second question that I raised before. Is slow fiscal adjustment good or bad? and I will argue that perhaps contrary to conventional wisdom, that the central bank should welcome slow or even no fiscal adjustment over the business cycle, for two reasons. One is that backloading fiscal adjustment is going to help stabilize the economy against aggregate demand shocks. It will sort of amplify and give you a dynamic version of the automatic stabilizer that will help you stabilize the economy and will ease the job of the central bank. And second, in the case of supply shocks, what will be happening is, as I will explain, is that such slow fiscal adjustment will help endogenously minimize tax distortions, minimize tax wedges, which will ease the inflation output trade-off in the case of cost push shocks. So my bottom line applied message is going to be, again, what may look like fiscal responsibility, not adjusting taxes fast enough following the recessions, that is a good thing. Yeah. So roadmap, I will start with a framework that is going to be rich enough to nest both the representative age and New Keynesian model and a simplified version of heterogeneous age and New Keynesian models. The essence, as I said, that will pick from heterogeneous age and New Keynesian models is going to be the presence of non-recurrent consumption. Whatever I'm going to tell you in the simple model extends to state-of-the-art quantitative heterogeneous age and New Keynesian models, and I will show you that at the end. I will first deconstruct fiscal dominance in rank. Once I do that, I will study fiscal monetary interactions in rank and try to deliver the second lesson. And now it's working. Perfect. OK. The building blocks of the model, aggregate supply, aggregate demand, policy. Aggregate supply is going to be a Phillips curve. The Phillips curve I'm going to use, I want you to be thinking in general, is some mapping from the path of output to the path of inflation, plus some disturbance, some cost push shocks. Okay? For some of the theory, we're going to be using a simple static Phillips curve just to give you clean answers. In the quantitative explorations, we'll be using either the standard or the hybrid Phillips curve, whatever the data want. Okay? And as I said before, elementary observation that I want you to keep for this class of models, not necessarily for reality or other models, is that I'm going to be looking, like many of us do, in models where inflation is pinned down by a Phillips curve. So it's pinned down by real spend. Aggregate demand. Aggregate demand is going to be a very simple extension of the representative New Keynesian model. It's going to be textbook New Keynesian model meets Blanchard. Overlapping generations of households with survival probability omega. When omega equal 1, households live forever. We're going to nest the representative age and New Keynesian model. When omega is less than 1, households die. Because they die, they become non-Ricardian. Somebody else may pay the tax burden in the future. Okay? That version of finite horizons, finite lives, is just a proxy, in our view, for the effect of borrowing constraints in complete markets. Incomplete markets break Ricardian equivalence, similar to OLG. Okay? And I'm showing here the aggregate consumption function because that's where a lot of the economics are going to be. So what this aggregate consumption function tells you, how we obtain this, individual optimal consumption, log linearized around the steady state aggregate across all households of different generations and the like. It has a component, that is like Friedman's permanent income hypothesis. If you look at the black, not the gray stuff, it's simply the consumption is a multiple, the marginal propensity to consume, out of what? Your financial assets and the discounted present value of your income net of your taxes. Okay? That's what you would get from Friedman Econ 101. Okay? The gray terms on the right are the effects of interest rates and the demand shock, a discount rate shock. Ignore the last part, focus on the first. When omega equal 1, we have literally permanent income, infinite horizon permanent income hypothesis. In that case, the MPC is 1 minus beta. It's 2%. Okay? And future disposable income is discounted at the rate beta, which is the interest rate faced by the government. So households have very little MPC, and discount the future with extremely low discount rate if you are in rank. Now, as you move from rank to OLG, what happens is households, because omega is less than 1, they have higher MPC, and they discount the future more heavily than the discount rate. Literally, this is because here households have finite horizons, but within complete markets, again, liquidity constraints give you high MPC. Liquidity constraints make people more less forward-looking. So in that sense, we're mimicking key properties from a general class of Hank models, okay? Now, you can think about consumption in terms of the consumption function, but if you use market clearing to replace C with Y, and private assets with government debt, and rewrite this equation in recursive form, with a little bit of algebra, you can show that you can write this in the bottom equation, which is like the Euler equation or the dynamic IS equation you have in the standard New Keynesian model, except you get an extra term that depends on the quantity of the public debt, if and only if omega is less than 1, if and only if you have finite horizons, and that captures the worth or liquidity effect of of fiscal policy on demand, okay? So I will be talking about the effects of fiscal policy that come through this red term. Fiscal policy, baseline, I want you to think, to simplify your life, risk-free, one period, real bonds as in borrow, later or in the papers, nominal debt or long-term debt, government budget. Debt accumulates depends on what is the interest rate, which is better invest, how much debt you have, what surplus you run. I'm writing here the surplus inclusive of interest rate payments. Okay, so surplus is taxes minus government spending and an adjustment for interest rate payments. And I'm going to be assuming the following fiscal rule, a fiscal rule that equates surpluses to a proportion of income, tau y times income, and I want you to think of this as the automatic stabilizer. If we have more real economic activity, if the economy is booming, automatically you are getting higher tax revenue and more surpluses. On top of that, you may intentionally adjust the tax schedule to raise taxes if you have a lot of debt. The second term captures precisely that kind of fiscal adjustment. If tau d is large, that means you are hiking taxes a lot when you have a lot of debt, or you are hiking them fast. So a high value of tau d means fast fiscal adjustment. A low value of tau d means slow fiscal adjustment. Tau d equals 0 means no fiscal adjustment. So what I'm going to be doing is understanding how the economy, the equilibrium behaves for different monetary policies as we vary tau d. Okay, that's going to be the key comparative static of interest. If I have slow or fast fiscal adjustment, what happens to the business cycle, what happens to monetary policy, and so on. Okay? Equilibrium, the usual thing, monetary policy, sometimes we describe monetary policy as a Taylor rule for interest rates. In the New Keynesian framework, effectively by controlling the nominal interest rate, the central bank can control the real rate. I want to be thinking of the central bank here directly regulating the real rate of interest, at least in the short run. Okay? Details how you can implement this with a certain rule for the nominal interest rate, but as I said, I'm going to be thinking the central bank controlling the real interest rate. And I will be asking two questions closely related. The first is how tau d, the speed of fiscal adjustment, matters for given monetary policy in the sense of a given path for real interest rates. And then I will be asking how it matters for the optimal monetary policy when the central bank chooses the real interest rate and its contingency to shocks so as to stabilize the economy, or to do its best in stabilizing the economy. Okay? So let's understand how tau d matters, how the speed of fiscal adjustment matters in rank versus Hank. And I want to zero in on what I said before, on within this model, fiscal policy can matter only if you somehow break Ricardian equivalence. Okay? To do that, what I'm going to do now is the following. Again, I will suppose omega equal 1. We have Ricardian households. And for simplicity, we can generalize, I want you to focus on a monetary policy that perfectly stabilizes the real interest rate to steady state value, which here means in terms of log deviations to 0. And I don't want you to get confused with the Euler equation, things like that. Let me look at the consumption function. I'm doing Friedman, okay, as basic as it is. So I look at the consumption function, and I see the consumption function, I'm going to rewrite it. Again, I wish I could show you, but the first equation that simply tells you consumption is the sum of two components, 1 minus beta z plus 1 minus beta, the discounted present value of income. So the second part is permanent income, as we learned from Friedman. What is this mysterious z? It's not very mysterious. Z is the private assets I have as a household in one pocket minus the discounted present value of taxes that I owe to the government, which is the obligation I have in the other pocket. Okay? Now, I'm a student of Barrow. So when Barrow taught me Ricardian equivalence, I understood as follows. Rational households should understand that whatever they have in the one pocket cancels out with what they have in the other pocket. Now, this is a property of rational expectations equilibrium, so it requires that people understand equilibrium, okay? But rational expectation equilibrium is what we use most often, not me, myself, in all my research, but in this class of models, that's the benchmark. So if agents have rational expectations, they should understand that in equilibrium, private assets equal government debt, equal present discounted value of assets, so they should understand that this Z cancels out. So in equilibrium, consumption has to equal permanent income. And in equilibrium, fiscal policy is nowhere to be seen in this equation. So now let me ask you, if the government decides to run more fiscal deficits today, what should happen to spending? When Robert Barrow taught me, he told me nothing, because Ricardian households understand this is a 0, so they shouldn't change their spending. Okay, I see it in this equation. But then I look at all the new Keynesian literature that assumes fiscal dominance in representative agent model, and I see equilibria where in response to fiscal deficits, there's more output and more inflation. How is this happening? The resolution is still in this equation, and the resolution is as follows, that in the new Keynesian model, income is demand determined. So this opens the door to a purely self-fulfilling loop. If we all spend more forever after, then our permanent income is higher, and then we can all spend more forever after. Okay? Now, emphasizing this self-fulfilling loop, that's what it takes within the model to sustain fiscal dominance. Okay? Now, I love multiple equilibria in general, but that particular multiplicity I'm very allergic to. Okay? Because it requires, through this lens, not everybody will agree with this prism, but through this prism, it requires consumers to coordinate on spending more when there are high fiscal deficits, simply because that's what it takes for the government budget to be satisfied. Okay? That's my interpretation of what fiscal dominance means in the representative agent Keynesian model. That's no claim about what fiscal dominance may mean in the real world. Okay? I'm not talking about how fiscal policy matters in the real world, but within these models, that's how it matters. As I said, this sounds suspicious in my view, and it turns out that it's very fragile in a sense that I have formulated, made clear in other work, but I will tell you one simple way to see this fragility. If consumers expect the economy to return to steady state, not asymptotically as we usually route our models, but in finite horizon, but in any finite horizon. Under this refinement, you cannot have fiscal dominance. The reason is simple. You can see it from the Euler equation. If y at some final period is back to steady state, you can iterate the Euler equation and get that y has to be in steady state forever and can only be affected by changes in real interest rates and not by fiscal policy. Okay? So if you use this refinement, that beliefs of real economic activity at long enough horizons are anchored to the steady state, then you get a unique equilibrium regardless of whether the Taylor principle is satisfied or not, a unique equilibrium where fiscal policy doesn't matter, and unique equilibrium where monetary policy is dominant, even if the Taylor principle holds. Okay? So my takeaway from that is that, I don't want to talk about fiscal dominance in the representative engineering Keynesian model. I want to go away from it to understand how fiscal policy affects inflation, demand, and the like. Okay? How does tau d mix in Hank? I can go back to the consumption function, and again, it's very simple to see what's going on. Consumption depends again on something like this Z and the discounted present value of income, but there's a big difference. When people look at what they have in their own pocket, they have private assets, that's public debt. What is on the other pocket is the discounted present value of their taxes, now discounting these taxes at a higher rate than the interest rate of the government. Why? Because either, again, I'm going to die and somebody else will pay the taxes, or because borrowing constraints effectively introduce extra discounting of the future. Okay? So now if you look at this CT, as you see clearly, is the discounted present value of taxes under the interest rate minus the discounted present value of taxes with the extra discounted by the households. As long as omega is less than 1, as long as households are non-Ricardian, this term is non-zero and has the following very natural property, which is important for what I'm going to talk now. If you push tax hikes further in the future, because households discount them more and more, you are going to stimulate demand more and more today. So the same size of deficit or stimulus check today will have a more stimulating effect in the economy if you backload the fiscal adjustment. That's the key mechanism. Okay? Once you focus on this mechanism, there are two lessons that come out relatively quickly. Okay, I want to say relatively quickly because we work hard to get the lessons, but I think they're intuitive. Okay? The first one is, of course, now, because households are Ricardian, deficits contribute to demand. Higher demand will mean both more output and more inflation. So deficits can be inflation. Everybody understands that. That's not our contribution. Okay? But what we have shown in this, in a paper is that to the extent that these deficits come with very backloading of taxes, which sounds like they may start looking at such unfunded deficits, in the sense, you run a deficit and you don't plan to raise taxes in the short run. Who knows what happens in the long run, but you don't raise taxes in the short run. Then you may start getting through this classical non-Ricardian mechanism sufficiently high inflationary pressure that can be quantitatively close to what you would have gotten in rank with fiscal dominance. So what I just told you is like, I may have almost negated my previous methods, but I think this is still a lesson. I told you that the mechanism that was there before in the literature is flawed, but I also told you that some of the applied lessons of this literature in terms of inflationary pressures of fiscal deficit or fiscal origins of inflation could be safe. Okay, so I think that's part of our lesson. The applied lessons, okay, lessons about lessons. Some of the applied literature that has focused, for example, Francesco Bianchi here, other people in this room, they have thought more about in the data how much inflation, how much fiscal deficit may have contributed to inflation. We may have used those models that have this problem, but perhaps if those models were proxy models with non-Ricardian consumers, maybe the answers they got in terms of the structural interpretation of the data was not that wrong. Okay? However, this new approach of looking into this comes with both more empirical discipline, because now how big are those inflationary pressures are within the model is not a question of untestable equilibrium selection. It's a question about measurable things, such as how fast fiscal adjustment is and how accommodative monetary policy is, in the sense of whether we raise real interest rates or not in response to government deficits. The second lesson that I want to use my remaining half hour to look at is, okay, once we think about this non-Ricardian mechanism, should the central bank prefer fast fiscal adjustment or slow fiscal adjustment over the business cycle? And as anticipated, my argument, we're going to try to make the argument that perhaps, ex ante may be counterintuitive, but ex post I think it will be very intuitive, that fiscal inaction in the sense of very slow adjustment or even no adjustment is good for the dual mandate of the central bank. For two reasons: it will help stabilize both output and inflation against demand shocks, and will ease tax distortions and the inflation output trade-off in the presence of cost push shocks. So what I'm going to do, and I'll let you take a break, and let myself take a break for a moment. I want to finish this digression that I had in terms of the representative age in New Keynesian model and the question of monetary versus fiscal dominance. I'm going to focus now on non-Ricardian Keynesian economies. I'm going to sidestep completely all this equilibrium selection debate and all those perplexing and controversial issues, and I'm going to focus on this very basic mechanism, non-Ricardian behavior, and how it affects optimal policy. Okay. That's the paper we're writing right now on fiscal inaction as monetary support, as support for the job of the central bank. Okay. So the description of the private sector, demand and supply, and of fiscal policy exactly as I did before. What I'm going to add here is a description of optimal monetary policy. And to talk about optimal monetary policy, I need to tell you what is the objective of the central bank. So the objective of the central bank is going to be the one you see here. It has two very traditional components, the output gap square and inflation square. So the central bank is trying to minimize both output gap fluctuations and inflation fluctuations. That's the standard dual mandate. And a little bit non-standard, somewhat non-standard is the last term that I'm also adding the square of R, of the interest rate. Okay? What I want to capture that? What I want to capture from this is something that is absolutely true in reality, but absent in the textbook macro foundation of the central bank objective. And to capture the idea that the central bank is like quick and large movements in interest rates because they want to be more gradual and more slow and more reserved on how they move interest rates for a number of reasons that you know better than me. Financial stability, uncertainty about what are the shocks hitting the economy, uncertainty about the transmission of monetary policy, the model we use about the world. As I want to think of this as other constraints to monetary policy, such as the ZLB in some situations, okay? So all I'm doing there is to capture the idea that the central bank, in the real world, unlike our textbook models, does not have free control of real interest rates, and through that target demand. So the central bank cannot easily get the complete first best of zero output gap and zero inflation even if you have demand shock. It can lead the economy in this direction, but cannot get the first best. Okay? That's all I'm doing. The normative question is how the optimal policy, the path of R star, the associated output and inflation, and the resulting loss, basically the total volatility in output, inflation, and interest rates, vary with tau d. And the intermediate step to this normative question is the positive question: if I were to fix monetary policy, what would be the effect of slower fiscal adjustment? So first I will explain you, for given monetary policy, what slower fiscal adjustment does. And that will help you understand whether this helps or interferes with the job of the central bank. So starting with the positive question, with the question, for given interest rates, first a lemma that tells you how you can understand equilibrium or represent equilibrium output in this economy. what the lemma tells you, and from here on, I'm going to be represent the economy under perfect foresight. So I want to be thinking that today there are some shocks that hit the economy today, but maybe we're also getting perfect foresight news about demand shocks or about monetary policy in the future. And I'm going to represent output as an IRF with respect to this kind of shocks. That's what equation 1 tells you. It tells you output in period t as a linear combination of the expected interest rate and demand shock E is the discount rate shock, R is the interest rate, in all future periods. Okay? These calligraphic Y are the IRF coefficients that, of course, you need to solve through the model. Okay? Now, any Hank model will give you some coefficient like this. You can solve the IAKC, the interpolar Keynesian cross, find the solution, you'll get something like this. Our G model gives you a closed form or a tractable characterization of these coefficients. Okay? So now I'm going to tell you what happens to these coefficients as I change the fiscal frameworks, as I make fiscal adjustment slower. And that's going to be our key positive result. Holding the path of interest rate fixed, slower fiscal adjustment, lower tau d, stabilizes dynamically the economy in the following dual sense. All these IRF coefficients increase as you lower tau d. So to interpret the sign of this increase, I want to think, if I raise interest rates or I raise discount rates, then you should be expecting output to go down. So you should be expecting these calligraphic Y coefficients to be negative numbers. Okay? It tells you basically higher interest rates, lower output. So these are negative numbers. So when I tell you that lower tau d, slower fiscal adjustment increases these numbers, it tells you that you're getting less of a recession. As I will argue, actually, they may even cross some of them and you get something positive. And I'll explain that. Okay? But in that sense, you are stabilizing the entire IRF of the economy vis-a-vis to both current and news about the future. The second part tells you that if you look at the cumulative IRF, again, because we're thinking it's like a recessionary shock, that's negative, the cumulative IRF. But as you lower tau d, you make this number closer to 0. It increases. And in the limit of no fiscal adjustment, you're going to make this number 0. So by backloading fiscal adjustment enough, you can perfectly stabilize the NPV of output. You can make sure that whatever recession you get today is perfectly offset by a boom in the future. Okay? So in that sense, slow fiscal adjustment can be a very powerful way to stabilize the economy, at least in an NPV sense. Okay? That's the statement. I will explain a little bit more the intuition in a second, but first I want to tell you the following. I want to keep that in mind. These are the IRF coefficients to the demand shock. So I told you the good news that slow fiscal adjustment stabilizes the economy against demand shocks. But demand shock and interest rate shock is the same thing. So the flip side of this result is that slow fiscal adjustment also stabilizes the economy against monetary policy actions. So slow fiscal adjustment reduces the effectiveness of monetary policy. Now that may sound bad, but in total, because you are going to be at this, the only reason that you are reducing the effectiveness of monetary policy is that you are reducing to start with the effect of the demand shock. So in total, it will turn out that the central bank is better off by this, despite the apparent reduction in the effectiveness of monetary policy. So let me explain this, what's going on, how this stabilization works. Okay? So I'm going to use not math because it's a bit more complicated, but some illustrations. So I want you to fix ideas, think about an AR1 demand shock that will create a recession in the economy. Okay? And I want to start with a situation where the adjustment, the fiscal adjustment is fast, So tau d equal 1. You get a recession, and the recession translates automatically to a deficit because your tax revenue is going down. So of course, debt will spike, which is what you see on the right-hand side. Now, what is happening, the fiscal authority is raising taxes a lot to try to bring debt down. If the shock had been IID, what you would have seen is debt spike for one period, and then it went down immediately because you raised taxes like crazy in the next period. Because the recession is persistent, you get a recession, you hike taxes, but then you're hit again by a recession, so debt will still remain above steady state, but will go back to steady state quite fast with the same speed as the economy recovers. Okay, that's the benchmark with tau d equal 1. So starting from this situation with fast fiscal adjustment, let me understand what happens to the economy if I lower tau d to less than immediate fiscal adjustment. And we're going to get the slightly less dark line, which is, maybe it's harder to see here, but let me lower tau d even more, and then you start seeing it more clearly. The impulse response of the economy is going up. That's the first part of my proposition. You are getting a smaller recession. What's happening at the same time? Well, you're not adjusting taxes that quick. Not surprisingly, debt initially is going up. Okay? But debt is going back eventually. It's going back for two reasons. One is that eventually you're raising taxes. The other is that because you backload the taxes, you're stimulating demand more for the non-recurrent reason that I told you before. Now these non-recurrent households understand, okay, there's a deficit now, which is effectively as if you're giving me back some money. Okay? And you're not going to take that money away from me right away. You're going to take them away from me much later. Okay? So the stimulating effect of aggregate demand is going to be larger when we backload taxes. That's why you're seeing output being depressed less. But since output is depressed less, that means that contributes to debt going back to steady state, even if you had not raised the taxes. That goes back to our self-financing mechanism of how backloading taxes helps stabilize debt without the need for significant tax adjustment. Now, what is happening if you're reducing tau d even more and more? You go to 0. Then as you can see in terms of the impulse response of output, you are getting a recessionary loan that is much more modest than we would have gotten otherwise, and you are actually getting a boom later on. What is this boom? How is that happening? Well, if you are not raising taxes fast enough, you allow some public debt to be out there in the market after the recessionary shocks has gone away. That means you have increased liquidity in the private sector even after the exogenous shock has gone away. So in this persistent increase in private liquidity, that will explain why you end up getting, you have relaxed borrowing concentration for the households even after the liquidity shock is gone. That explains why you are getting a boom after the initial recession. Okay? And as I told you, if you were to integrate that line, you are going to get exactly 0. I'm not going to explain why exactly you get 0, but I want you to understand that slow fiscal adjustment will give you a boom later on that will help moderate the recession today. Something also to note from that is the following. That has the flavor of forward guidance. What do we do with forward guidance monetary policy? You promise to stimulate the economy in the future, and that helps you stimulate the economy today. At least in the theory. Whether it works in reality, it's a big question, okay? So another way to interpret the result I just told you is the following, that slow fiscal adjustment it implements a sort of forward guidance on the fiscal side instead of the monetary side. And it works because households are non-recurring. Okay? You are creating fiscal stimulus effectively in the future. Okay? Now, I'll skip the limit. What happens with, that was what happens with given interest rate, with given monetary policy. So now let me explain what is the implication for optimal monetary policy. And I think now you must almost guess the result, okay? So I'm going to argue that the strategy for proving the result is you look at the envelope condition that gives you how the optimal loss of the central bank depends on the speed of fiscal adjustment. Now, this naturally depends on two objects, the optimal allocation and the sensitivity of output to tau d. We already characterized what's the sensitivity of output, of the impulse response of output to tau d. That was the previous result. The properties of the optimal policy is relatively easy to understand from what we already know. So you put things together and you can understand what happens to the CB loss as a function of the speed of fiscal adjustment. And the result is as follows, that for, oops, there's a typo here. The first line should be for demand shocks. Okay? For demand shocks, I'm telling you that the loss increases with tau d, which means the loss is minimized when tau d equals 0. So the central bank prefers very slow fiscal adjustment in the case of demand shocks. And conversely, for supply shocks, it's the opposite. For supply shocks here, the central bank prefers fast fiscal adjustment. What's the intuition for this? Based on what I told you before. The stabilizing effect of low fiscal adjustment of output is true regardless of whether you have demand or supply shocks. In the case of demand shocks, the central bank is trying to stabilize output and inflation. And the slow fiscal adjustment helps the central bank. What happens with supply shocks? If you have a cost push shock, the central bank is not trying to stabilize output. In fact, with a cost push shock, the central bank, the optimal monetary policy, tries to destabilize output in order to stabilize inflation. If you have an inflationary cost push shock, the optimal monetary policy is to reduce demand, reduce output, so as to lean against the cost push shock. So the central bank, in the case of supply shocks, is trying to destabilize output. Now, I told you, slow fiscal adjustment stabilize output, but now slow fiscal adjustment in the case of supply shock goes in the opposite direction of what the central bank wants. So that's why it's going to be bad in the case of supply shocks, where it was good in the case of demand shocks. And this is an illustration now of what happens to the impulse response of output and debt and the total demand wedge in the case of demand shocks. Basically, even though monetary policy adjusts in here, what you see is the following. If tau d is close to 0, that's the light gray lines, the recession in the economy is weaker, comes together with some boom later on. That's the fiscal co-organised that I told you. Now, if you also look at the demand wedge, the shock is always the same. So when you look at the IRF of the demand wedge, which is the sum of the shock and the interest rate, you're really seeing what happens to monetary policy. And the lesson there is the following. You have a negative demand, this is yes, you have a negative, contractionary demand shock. Optimal monetary policy fights this by lowering interest rates, both now and in the future. But those movements are costly or difficult for the central bank. What the slow fiscal adjustment does is, yes, it reduces the effectiveness of monetary policy, as I told you before, but it gives you for free more stabilization. So now the central bank can achieve more output stability and more inflation stability, even with less action on its side. So there's less need to move interest rates as aggressively as before. Okay? Conversely, in the case of supply shocks, slow fiscal adjustment reduces the recession that the central bank is trying to create in the case of inflationary cost push shock. That not only increases inflation, okay, so you're getting worse outcomes in terms of inflation, which we were trying to fight. So slow fiscal adjustment, maybe for the post-COVID shock, maybe that's bad, I don't know. But for cost push shocks, that's where it's bad. Okay? And not only that, if you now look what happens to interest rate policy, you will see that the following interesting pattern. So if I start from very fast fiscal adjustment and I make it a little bit slower, the fiscal policy works against the central bank. Initially, the central bank tries to offset the bad fiscal behavior by moving interest rates more. But if fiscal adjustment is so slow, then output is so well stabilized by the fiscal authority that the central bank gives up. It's demoralized and says, okay, it's pointless for me to try to stabilize output because the effectiveness of monetary policy now is low. So you are getting that even the optimal monetary policy response is now smaller when fiscal adjustment is low. So bottom line, I've already said this 2 times, so I'm going to repeat 3 to make sure it registers. Okay, if I think about whether lower tau d helps or not, the description, the lesson so far is the following. This is describing, think of the solid lines. The blue line tells you whether the loss looks like as a function of the speed of fiscal adjustment in the case of demand shocks, the red in the case of supply shocks. For supply shocks, you want fast fiscal adjustment, tau d equal 1. For demand shocks, you prefer slow fiscal adjustment. The dashed line tells you how all this objective changes, how this trade-off changes, if you change tau I, which is the size of the automatic stabilizer. So if you have a stronger automatic stabilizer, the usual automatic stabilizer, that's going to be good in the case of demand shocks and bad otherwise. Okay? So far, I promised in the beginning to tell you that slow fiscal adjustment is good always. What I told you now is slow fiscal adjustment is good for demand shocks, bad for supply shocks. That's an important lesson. Okay, and I want you to keep it. That's, okay? But now I'm going to give you an extra lesson that will tilt in the direction of slow fiscal adjustment, even for supply shocks. So far, when I thought about fiscal adjustment, the tax hikes were not showing up in the Phillips curve. They were only affecting demand. That meant that effectively I was assuming that all the tax adjustment is non-distortionary. However, if tax hikes are distortionary, they hurt labor supply, private incentive, and the like, that will manifest as a tax wedge in the Phillips curve, effectively as an endogenous cost per shock proportional to the tax adjustment. So now let me move to this situation and adjust the Phillips curve. Again, maybe you have the forward-looking or the backward-looking components, but the key thing is now I'm going to add this tax wedge in the Phillips curve. And I want now to focus what is the extra mechanism brought from the supply side now. Okay? And given time constraints, I'm not even going to go through the math, but I will just give you the basic intuition, which is the following. I told you before that regardless of whether you have a demand or supply shock, slow fiscal adjustment helps stabilize the net present value of output. But if you stabilize the change in the net present value of output, you are also stabilizing the net discounted present value of tax revenue, because if the net present value of output doesn't move much, tax revenue in net present value is not going to move much. So with fast fiscal adjustment, you are going to have big net present value of tax hikes because you are not getting tax revenue for free and you need to substitute for it with tax hikes. Backloading those tax hikes by stabilizing the present value of output also stabilizes the present value of tax revenue, which means that you can get intertemporal government budget balancing without tax hikes. So by backloading tax hikes, you make sure that the net present value of tax distortions doesn't move in the economy. Okay? And that makes those tax wedges to be small endogenously, thanks to the non-recurrent behavior in the channel I described before. So fast fiscal adjustment is going to be bad because it will create this endogenous cost per shocks. Slow fiscal adjustment will minimize this endogenous cost per shocks and ease the trade-off between inflation and output, even in the case of supply shock. That's why now, even in the case of supply shocks, it may be that you prefer slow fiscal adjustment. So to sum up the theory, and then I'll conclude with quantitative application, the theory has told you so far, has given you reasons why slow fiscal adjustment may be good, but didn't tell you always it's good. Okay? It gave you some conditions for it to be good. The conditions was The first one I didn't explain enough, but you need sufficient non-recurrent behavior, of course, and a sufficient fiscal automatic stabilizer. But it's more likely to see slow fiscal adjustment being preferred if demand shocks are the main driver of the business cycle, and if the inflation pressure of tax distortions is sufficiently high. Okay? Now, is the business cycle driven primarily by demand or supply shocks? We have guidance from the empirical literature about that. I think most of us would argue that it's not TFP shocks that drive most of the business cycle, but some kind of demand disturbances that are not fully offset by monetary policy. The second, what's the inflationary pressure of tax distortions? I don't know evidence about that, but we can use standard estimates of the elasticity of free labor supply and so on to calibrate the model. So what we're going to do in our quantitative application is the following. First, we're going to, the application, with apologies, is going to be in the US, not in Europe. But what we're going to do in our richer model is the following. On the demand side, so far I use a stripped down Hank model, an OLG model that focuses on the non-Ricardian aspect, but assume the way heterogeneity. So we're going to write a richer model which will accommodate heterogeneity both in MPCs and in wealth in wealth holdings. Okay? Particularly, we're going to have agents who are relatively poor and have relatively high MPCs, and the agents who are relatively rich and have relatively lower MPCs. And that will approximate very well what you get from quantitative Hank models. On the supply side, we are going to use a realistic hybrid New-Keynesian Phillips curve, what the data like, calibrated the more recent evidence about the Phillips curve. On the fiscal block, tau y, we're going to calibrate on what is the average rate of taxation. Debt to GDP, we're thinking here about debt held by the private sector in the economy, standard things, and the maturity structure because we'll have long-term debt. What about shocks? Shocks will take two approaches. You could think about writing a maximum likelihood estimation of this model. We're going to follow a different approach, which we think is a bit more transparent. The demand block and the supply block, the key parameters, are going to be disciplined by evidence outside the US time series. Okay? In particular, the demand block, we're going to calibrate it to evidence about intertemporal marginal propensity to consume and evidence about wealth heterogeneity. The supply block, from what I told you about identified Phillips curves. Okay? That leaves us with only one thing to be identified in the data, the shocks. So for that, we'll follow two approaches. One by my co-author Chris and co-authors, his co-authors, not the rest of my co-authors, where simply takes the following simple idea. If we know the rest of the parameters of the model and we only don't know the shocks, we can identify the shocks basically by the Wald decomposition of the data. So you can use the Wald decomposition of the data together with the primitive parameters that I told you before to create counterfactuals about how slow fiscal adjustment will matter without putting parametric restrictions on whether the demand and supply shock are AR1 or MA or whatever. Okay? And another simpler version is, from my work, you can represent the bulk of the business cycle as some sort of a principal component that looks like a demand shock. So if you do this, and you ask what is the CB loss, basically the sum of output volatility and inflation volatility as a function of tau d, you are going to get this figure for the US data. Focus first on the gray line. The gray line is with distortionary taxes and with the Wald decomposition of the data. And you see here that the optimal, the preferred tau d is extremely close to 0. The other two lines give you two variants. The red line is what if you had lump sum tax adjustment instead of fiscal. The blue is if all the business cycle was demand shocks instead of some mixture of demand and supply shocks. The picture is the same, so I'll conclude with here. I gave you some intuition of why with non-Ricardian consumption behavior, slow fiscal adjustment or fiscal inaction may be welcome. over the business cycle. Obvious caveats, whatever I said, uses the new Keynesian model, presumes output is demand determined, so it's about the business cycle, nothing about structural trends, steady state, and the like. And I'll leave it here. Thank you.
So that was a tour de force of covering such a wide range, and more or less an hour of continuous presenting is, especially after a transatlantic flight, is quite something. So I think to give Marios a little bit of a breather, we'll collect a number of questions before going back for any answers. So Oscar here in the middle. Oscar, thank you.
Thank you very much for this excellent presentation. So two brief comments. One on the semantics remark that you made at the beginning of your talk on fiscal dominance. I think I would fully agree with you. I mean, the channel you are exploring, I think is fully in line with the normal prescription that any central bank model would probably produce. I mean, if I ask any ECB model about the likely outcome on inflation of more public spending that is at least partially financed with debt, the empirical answer would be more inflation, which is not about fiscal dominance. It's about fiscal relevance for macroeconomic outcomes, including inflation. And probably through the channels, in part, that you are analyzing here, through non-recurrent channels. So I would agree it's not about fiscal dominance, it's about the relevance of fiscal outcomes for inflation. No? That in regular work here at the ECB, I guess the same is true for any central bank in the world, are absolutely central to our routinary analysis. No? Now, more fundamentally, I mean, if I were to focus on which I think is the most relevant quadrant of your analysis for us, for the euro area, which is one in which supply shocks are probably more relevant. This was one of the takeaways of our analytical work in the last strategy review. We should probably be prepared for more frequent and more intense supply shocks, negative shocks perhaps. And in face of frictions, you highlighted tax distortions. My conjecture here is that perhaps a temporarily negative tau D, a temporarily negative reaction to debt, that is countercyclical fiscal policy, could be part of an optimal program, no? In mind, I have an example, and I would like you to tell me whether it makes sense or not. In 22, following the huge increase in energy prices, many European governments spent public money in putting some limits to the increase in energy prices. And this facilitated, to some extent, the life of the central banks, because total inflation was more limited than otherwise, and this in the presence of nominal rigidities, in particular a strong wage rigidity in some countries. And let's think about Germany. It takes like 3 years for some wages to adjust. This implied that the erosion of real purchasing power was lower thanks to these fiscal programs. So at the end of the day, the persistence of the shock and so on was, in terms of inflation, was lower than in the absence of this counter-cyclical fiscal policy, which I think it facilitated to some extent the reaction of the central bankers. It allowed us to be a little bit more smooth in terms of the management of the interest rates and so on. So would it make sense to relax the assumption that tau D should be positive and consider possibly temporarily necessary negative values for that key parameters? Thank you.
Thank you. Rodrigo, Oscar, give it to Leo.
Thank you. Super interesting, the presentation. Three comments. One is very related to the previous one. But the first one is whether you have testable implications from here to differentiate from fiscal theory of the price level at the end in the data. Second is whether I interpret correctly the numerical exercise. At the end, a fiscal rule around a structural or cyclically adjusted deficit is the quote-unquote the optimal one from the eyes of the central bank. That I guess is the implication. And the third question is, if you had to think about a reaction function now from the government, how you would think about that? We will have a similar loss function. What if they have discretion, fully discretion? What happened in that case? Very interesting, the point of the negative tau. I guess also there are some fiscal policies that are not directly demand policies, only indirectly, like subsidies. No, a fuel subsidy is something that is not fully captured here. So perhaps, I don't know, that opens also the toolkit.
Okay, thank you, Rodrigo. Oreste, and then Leo. Okay.
Yeah. So thank you, Marius. Two clarifying questions. On the first one is on the reference you made to the New Keynesian literature on the fiscal requirements for price stability. I thought that one way to understand the Woodford and Gali, the textbooks, is it's convenient for the central bank. Well, the central bank operations are easier if the intertemporal budget constraint of the government is satisfied by the government. And from this perspective, you are imposing the same condition. Now, I understand you're going beyond that, but I just wanted to make sure that this was, again, a clarifying question. And the second one, also on the clarifying side, is you emphasized a lot the need, a key property, this lack of Ricardian equivalence in what you're doing. Is this the only, is it a sufficient condition? So I was just wondering, for example, we had this morning another paper with a two-agent type of, tank type of model. Would this also hold in that kind of model?
Thank you. Leo, then Jessica at the back there.
Yeah, I mean, thanks a lot. This was a super rich presentation, of course, very, very well presented. Maybe just also more on the clarifying side. The real interest rate, and you talked about this a lot. I mean, there's a preference for you to keep this over the cycle, rather don't move it much, keep it constant. But and this made some of the expositions very clear. But when you did the optimal monetary policy problem, second part of your presentation, maybe you could make things clearer if you add to this, maybe you do it somewhere in the simulation also, the optimization problem without constraining the real interest rate. And I say so because if you want to link finding maybe two things that you have from New Keynesian setups with the Taylor rule operating there, of course, the strength of the real interest rate channel, Taylor coefficient larger than 1, less than 1, is very important kind of for the properties you see. And this essentially you take out at the beginning. So this could help maybe to compare what you get with other papers in the literature.
Okay, thank you. Jessica, then Klaus.
So, great presentation, and the rank part I love and I'm all in on. And in terms of the Hank part, I guess there seems to be a couple assumptions that are doing a lot of work. One is the borrowing constraint, and the other is the R squared term in the central bank rule. And I wonder if just another interpretation of the data, and maybe this is similar to the point about the fiscal theory of the price level, is a fiscal authority that's been captured by special interests and is spending more than it should. If that is just maybe an equally good explanation of the data with very different normative implications.
Very good, Klaus.
Thank you. Thank you for the wonderful presentation. You could really follow even without looking at the formulas as so well you explained. My question is similar to following on to Oscar's. If you think about the US, there was a huge demand shock, COVID, the fiscal policy very expansionary, and then inflation went up. At that point in time, fiscal authorities in the US were very slow moving back to, I mean, there was no really consolidation, which meant that inflation went up and up to almost 10%. So in this period, what would your optimal monetary policy say? There was little of an unemployment increase after, say, 21, 22, when fiscal policy could have stabilized more. So was it optimal for monetary policy when inflation went to 8, 9%, that fiscal was so reluctant to really consolidate? Or was at that point in time the objective function of monetary policy all on output and very little on inflation? Thanks.
Okay, so you've accumulated a mix of comments and questions. I don't expect you to fully address everything, because we need to leave some of this for the reception and the dinner conversation. But if you want to take a couple of minutes.
Perfect. Thank you very much, and thanks for all the interesting questions. A lot of homework also for me to think. Some quick answers. Completely agree that we should separate fiscal relevance from fiscal dominance, and I think part of the problem is sometimes we use the same word to talk about very different things, and that's where theory is useful, to clarify things. And that's what I try to do primarily, to clarify how things matter. In terms of whether it can be optimal in some situations to have like even tau D negative, I agree. First of all, if you have, it's not so much for the energy example, and that goes back to another question. I didn't have subsidies to particular sectors, but if you start having subsidies, that's a way to directly counteract the cost push shock. So that was not the analysis, and that, there's a clear, reason why you would like to subsidize costs when the costs go up. Okay, and that was not in my analysis. Okay, but you can think of tau D negative proxy for that. Testable implication. I want to get into that. Okay, it depends on whether we think about testable implication in terms of only macro data or micro data. For macro data, yes, there are differences. With non-recurring households, if you give them a deficit or a transfer, they're hungry. They're going to spend it very fast. So what you should expect is a boom in spending output inflation that is very front-loaded and short-lived. Instead, if you are within the fiscal zero price level, those households are really trying to smooth consumption forever. So those fiscal shocks generate very persistent movements in spending and inflation. Now, I'll let you, I don't know, the post-COVID experience was inflation spiked, but then went down. Who knows what happened in reality? But I'm telling you, that's a testable difference of the macro data at the macro level. Micro, it's trivial. Consumers are not PIH households. Once you have non-recurrent households, we can just forget the whole debate about non-testable equilibrium selection, talk about this standard classical mechanism, and then we don't have to worry about it. It's true that this, as I said, this classical mechanism can give you outcomes that resemble FTPL at the macro level, okay? But now you don't have to, obsess about whether John Cochrane is right about the model or where I'm right. It's like we can forget all this controversy and focus on what is interesting, which is outside from the equilibrium selection. There was a question about the intertable budget constraint. I'm happy to talk more about that at dinner. I want to emphasize the following. Again, this is like perspective, but for me, that perspective is very important. If households are Ricardian, they don't think about the budget constraint of the government. It's out. It doesn't matter. Okay? So then the government will either have to satisfy somehow the budget constraint, so fiscal policy has to be active, or then we cannot have an equilibrium. But what I learned from that is that if I'm in rank, active fiscal policy is not a meaningful assumption. Okay? Tank versus Hank. Tank is a very special, degenerate version, so it has some issues. But if you're in a generic Hank, whatever I told you goes through. R square, if we didn't have the R square, let me be clear about the following. With supply shocks, everything I said would have gone through, because with supply shocks, the central bank is not getting the first best. It's in the second best already. okay? With demand shocks, if you are in the textbook New Keynesian model and you don't have some friction in monetary policy, then the central bank gets the perfect first best, okay? So in that case, then the monetary authority is stabilizing demand no matter what the fiscal authority is doing, and then fiscal policy becomes irrelevant, okay? But that's a knife-edge property of really getting the first best. Anything that will keep the central bank optimum away from the first best will let the mechanism happen. So the R square, and actually whether it's R square or the nominal interest rate square or the nominal interest rate today versus yesterday, the change in interest, all of that will give you the same answer. Post-COVID, now I forgot what the question was. Maybe that's a good moment to stop.
Okay, very good.
Thank you.
So with that, I think we've had an excellent day. Let me thank all of the speakers, everyone who was energetic in asking questions, all the discussants, this is of course just one day out of two. So with that, I'm going to close the live stream. And then I'm going to ask the organizers to fill us in on the details of the reception and dinner. So thank you, everyone.
Thank you.